Hi everyone, and welcome back to another episode at The Independent Dollar. If you're joining us for the first time, this channel focuses on personal finance videos in a way that's straightforward, unbiased, and easy to understand. Today we're going to be diving into ETFs. How were they created? The pros and cons related to asset allocation, and taking a closer look at Canadian equity, energy, and financial ETFs and their respective performance. While ETFs are commonly a favorite among self-directed investors, the growth in the ETF market has been across all investment platforms, including advisor-managed fee-based accounts, large institutional accounts, foundations, and trusts in order to manage risk and reduce fees. But for individual investors, while the increase in options for ETFs has been great for choice, it can be quite confusing when looking at each ETF and trying to decide which one to buy. We'll take you through a quick primer on how ETFs work, how they are different, and what you should look for when constructing your own portfolios. What is an ETF and how does it work? An ETF in the most basic form is a share that you can purchase online that holds a basket of investments or attempts to replicate a group of investments. That may be the Canadian equities, US equities, global bonds, or a mix of those and other investments. If an investor wanted to invest in Canadian stocks, then they would likely look for something that mimics the TSX Composite Index. Similarly, for the US, they may want to have exposure to the Dow, the Nasdaq, or the New York Stock Exchange. There are also indexes for bonds, GICs, and even sectors amongst many other options. An ETF provider has a few choices as to what they want the ETF to accomplish. Do they want to follow the index exactly by purchasing every stock, or do they want to purchase a specific selection from the index? Purchasing every stock in the exact weighting will provide the truest results to the index that they are tracking, with the difference being only the fees. However, when an index is quite large, the task of replicating is cumbersome, and in those cases, the ETF provider will typically pick a handful of securities that mimic the overall characteristics of the index and invest in those instead. As the index changes over time, those securities will be sold and replaced. These examples have been for passive ETFs, which require much less hands-on work and typically have lower fees. For investors who are looking to have a more hands-on approach, there are active ETFs. In that case, there is a portfolio manager who will actively trade the holdings of the ETF in an attempt to lower risk, increase returns, or a combination of the two. And this is similar to how a mutual fund is run, but in ETF form. Now, we previously released a video on ETFs and mutual funds that goes into much greater detail to the differences between the two, including tax issues. We'd highly suggest you check it out if you haven't had a chance to already. With so many options, are a lot of these ETFs the same? Well, not really. You might think it would be easy to go to your advisor or your online brokerage account and request a Canadian ETF. As ETFs have started to become more prolific, the options have increased, as we can see here. This is just a small selection of ETFs that will give you exposure to the Canadian stock market. As you can see, the one-year returns for these can differ dramatically, so it's important to take a closer look at what you're actually purchasing. Let's start by looking at the 4 iShares offerings: iShares Canadian Growth, S&P TSX 60, S&P TSX Completion, and S&P TSX Small Cap ETF. All 4 of these ETFs will track the Canadian markets, but in different ways. The S&P TSX Composite Index is a benchmark Canadian index and has approximately 250 companies in it. There are very specific requirements for a company to be part of that index, so some of the names will drop off and then come back on again over and over. The S&P TSX 60 is a subset of this index, representing the 60 largest companies by market weight. Since they're the largest in the index, the companies will be more static, and it is these 60 stocks that will make up the iShares S&P TSX 60. If you wanted exposure to the rest of the index, then you could purchase the iShares S&P TSX Completion, which has the remaining 190 stocks. The other 2 ETFs have different goals. The iShares Canadian Growth ETF follows the Dow Jones Canada Select Growth Index. This index has 44 holdings and is made up of large and medium-sized Canadian companies that have earnings expected to grow at an above-average rate. As you can see, these companies have performed well in the last 3 years, but lag behind the TSX 60 index over 5 years, and are pretty much a wash over 10 years. The iShares Small Cap ETF is focused on smaller-sized companies that would not be part of the S&P TSX Composite Index, and in this case is largely made up of materials, industrials, real estate, and energy companies. As you can see, there are many decisions to be made and much research to be done if you are looking to buy an ETF. Now, perhaps you were looking to supplement your existing portfolio and you wanted to buy a Canadian ETF that invests in the energy sector or banks. You will face a similar issue, however, as the names of the ETFs do not always tell the full story. An ETF that is named Canadian Energy or Canadian Oil may very well invest in those types of companies, but they may be more niche than you expected. You might be purchasing an ETF that invests in one or all of the following: the price of oil futures, the extraction of oil, oil pipeline construction and maintenance, or oil refinery. Another example is the Canadian financial sector, which has the following as a small sample. Some of these ETFs have each bank in the portfolio as an equal weight, regardless of their size, whereas others are weighted exactly to the index but may cap the maximum weight at a certain amount. As well, some will include life insurance companies or try to position the portfolio to generate the most amount of dividends, and they do this by purchasing more of the banks with higher dividend payouts and less of the ones with low payouts. All in all, the ETF universe can be quite complicated because we're now spoiled for choice as to what we can purchase. All of this selection allows you to customize your portfolio as little or as much as you want. With all of that in mind, how can we simplify things when deciding what to buy? A fairly new entrance into the ETF market is asset allocation ETFs. These are an ETF that you can purchase that has a set asset allocation that it follows, and then will purchase a bundle of other ETFs on your behalf and rebalance when necessary. An example of this would be the Vanguard Balance ETF portfolio. As we can see from their fact sheet, it's made up of 7 of their broad market indices. This will allow you the exposure to a wide selection of stocks and bonds without having to understand what Global X US Aggregate Bond Index is and FTSE Developed All Cap X North America means. There are downsides to these ETF portfolios though. If you think back to our ETF and fund taxation video, any extra trading within an ETF may trigger taxes at the end of the year. This portfolio and others like it will constantly be rebalancing, either as a set interval or when the asset allocation drift is too far. Each ETF provider will have different rules to rebalancing, so it's worth taking a look into them. The other is the additional cost of having a portfolio of ETFs managed on your behalf. The total MER may be slightly or significantly higher than if you were purchasing the ETFs on your own. In this case, the MER for the Vanguard Balance portfolio is 0.25%. If you purchase the ETFs individually at the same weight, the MER would only be 0.16%. So you are paying a premium of 0.09% for the ETF provider to manage on your behalf, which is actually over 50% more. However, when you factor in the trading costs and time, this may be worth it for the average investor. We hope you enjoyed this video on ETFs in Canada and what to watch out for. As with any investment, every little bit of research will help you immensely before diving in too deep, because the cost of correcting mistakes can be quite expensive. If you have any questions, you can always reach out to us via our website or comment down below to let us know. Thank you so much for watching, and we'll see you back here on Tuesday.